Okay, so I dabbled a little bit in the technical today when I put together today's presentation, but it's definitely, I'm still leading with psychology, so I still get to call it my psychology lab. But I've been thinking about this whole concept in terms of timing the market, both literally intraday in our timing in our trades, but then also like bigger picture trading journey. So I'm so thankful you guys are hanging out with me on this wonderful spring Tuesday. Thanks for being here on Tuesday, spending your afternoon with me. I am pretty excited to talk about all kinds of factors around timing the market. So not even just in specific trades, but all kinds of factors, and how that can be a big issue when you're an early to middle trader. Is this can be like the most frustrating part of trading in my experience is mistiming your trades. Whether it's like you really see a short is coming, but you get in and you just get stopped out and then the trade progresses and falls 100 points or something. That can be so frustrating. And that's the same with a lot of factors of trading. You can be almost right, but then how much risk can your account hold in order to see it play out? And what does that look like for how you adjust your strategy and your entry and exit criteria and how you conceptualize your whole approach to trading? And so timing is like a big factor with that in a couple of different ways. So I want to just delve into it and lay it out there, and you guys definitely ask me questions and see if I can do it justice here. But I think it's a skill in trading that I certainly could do better with. And I think that that's not super uncommon, that I think many people can really do better with timing the market in a couple of different ways. And so you guys have heard me say before too, but these labs are just as much for me as they are for you, because they really help me shore up who I want to be as a trader and encourage me to be my best successful trader self, because the topics that I cover are topics that I think are important for traders, not just like who I'm talking to, but me as a trader. Okay, so this is a breakdown of how we're going to approach it today. And it's basically that the market does look easy from the outside, right? People who trade the stock market can make a lot of judgments on traders and why aren't you successful and can't you just buy and on the pullbacks and hold to the highs? Yeah, that's exactly what we do, but it's not actually as easy. And so when you are in trading, when you are learning to trade, when you're dialing in your system, there's a lot to factor in. And so today we're going to talk about the mechanics and psychology and strategy behind knowing when to pull the trigger on your trade and maybe what you should factor in to wait. So we're going to define timing, talk about windows and volatility and the different opportunities intraday, what can go wrong when we're trying to get our best entries, and then also psychology and action and caution versus courage and how you need to find the balance with all of that and have yourself set up for the best outcome that you can in a day. Okay, so let's just get into it. Timing the market, what does that actually mean? So let me start with just clarifying what I'm talking about and what we can glean from all of this. So I think that a lot of traders think about timing as just picking a direction more so, today's a bearish day or a bullish day, so I just need to get in for a long. But as we know, we've been in this market a little longer than that. There's so many factors to consider with this, especially in futures. It operates on multiple different layers simultaneously, not even just time frames. So if you are only focused on one or two things with your trade and you forget about other factors that are important to play into it, it can be less helpful. And so today, the goal of today's conversation is just to bring up topics around timing your trades that can maybe help you just be even just a little bit more successful with the opportunities. Excuse me. You guys hear me good? My mic is in a desk that's set up a little different today. Let me know if there's any trouble there. Okay, so macro timing. Okay, so this is something that we talk about. You guys know we stream Is There a Ring to Rule Them All? Let me see if I can bring it together for you, Ace, because I think I got a plan. Okay, so on our BluSky Skycast podcast that we record with you guys every Monday at 1 p.m. Eastern, this is something that we cover every time, and then we talk about throughout the day during our streams as well, and likely as a part of your process. But that's paying attention to macro factors that could influence your trading. So this is including things like the cycle and the economic cycle that we're in, and if we're coming up on important information such as FOMC or CPI, what the inflation situation is, what sectors are rotating, if it's expiration Friday, these types of things, they will shape the environment that we trade within. And so that is just something easy that you want to always check off your box and make that constantly a factor that you do in your trading. So not much more extra to add in there, but always pay attention to have that part of your process to make sure you know what is coming, because some of that is scheduled. And so there isn't any randomness with it. And there's certainly random bits of information that come out of the government that we can't plan for, such as who's flying where, when. But the macro things that you can anticipate is good to pay attention to. Now, fundamental timing is similar. That's the fundamentals that drive the market, such as earnings and federal statements, CPI, these events can invalidate a setup in seconds because they causes an influx of volatility that will sometimes just, even if your trade direction is right, it can cause so much wicking and extra contracts being exchanged on the market that your stop can get taken and then you can just be stuck holding the loss while the trade works out. And so knowing right with a minute when those scheduled bigger news impacts are going to hit, you want to protect yourself and have coverage or just not trade during that time if you want you trade with a smaller account size or a tighter stop loss, or you're not deep into profit and you can protect yourself by moving your stop. So pay attention to those fundamentals that could be a factor. And then intraday. So this is going to be the part that is the most intricate for us as futures day traders predominantly, because that is kind of where we live, right? Where we execute if you are trading your prop account. And so what session are you in? What hour are you in? How many minutes until the close? How many minutes until the open? And so getting into the specifics of the opportunities intraday is something to always factor in, right? Because volatility is different at different times throughout the day. And so you're going to want to approach that differently. And I think a lot of people, if you've been around the market through an entire New York session or your session wherever you live, you'll notice that it is different, like in terms of volatility, which can be seen as candle size, right? How much risk you'd have to take certain criteria is how much volatility is in the market, how big the candles are. Okay, so let's pull the audience, see who is like ready to get into this with me. How many of you had a trade where your direction was right, but you still lost? Okay, so if you know what I mean, drop the emoji for how that experience was for you in the chat, because let me find my emoji for that. This is it for me. Like, dang it. Like, I knew I was going to go short. I should be capital. I should be at max profit. I should be a home run day. Like, this was my experience. I think this actually is really like a common experience for traders, right? It's just, this is the life that we're in. You can't it's hard to nail your entry on every situation as much as we wish we could. So, all right, pretty much all of us have experienced a situation where your direction was right and you still lost. So let's try and just unpack that a little bit and figure out how we can do a little less of that. Me as well as everyone here, right? So why the macro layer matters. We're going to just cover this in the beginning because we need to, because it's a factor, but I won't spend too much time on it. But futures markets are global instruments. The S&P, crude oil, gold, bonds, they're all influenced by forces far larger than any single chart pattern. They are a big beast, and they sometimes operate on things that are outside of the 5-minute range. And so that's important to pay attention to those bigger external factors that are scheduled in and could be anticipated to one degree or another. And so sometimes, you guys, a beautifully timed intraday entry can be just destroyed by a surprise federal comment or someone from anyone higher up who has a vantage point to say things. Exactly. So from whatever tweet could randomly happen, but a geopolitical shock, a currency crisis, something going on in the other sides of the world. There's something going on right now. Matt could probably comment on this. There's earnings after market today. So there's going to be potentially some outsized moves after market today, as well as tomorrow, even more so than today. So I'm going to nerd out on my slides and you guys watch the candles for me. But definitely this is earnings week. This is a big earnings week. So there's going to be some aftermarket moves today and tomorrow for sure this week. Okay, so understanding where the macro winds are blowing doesn't mean you're predicting everything, but it means that you don't trade blindly against the tide. So, understand where the winds are blowing. If you can envision that in your mind, it's like, what is the overarching energy behind the movement we're seeing in the markets? Like this, we've been seeing a bull trend for the last couple of weeks, right? What was the energy behind that? What are the factors? You can consider that we're going into a strong earnings situation and that we have not actually engaged in war last time I checked, which is current as of 10 minutes ago. Crazy. Thank you for being here today because, dude, these conversations always ground me. So thank you. I appreciate that. So macro factors that can shift your timing, right? So these are the things just, Federal Reserve policy stance or rate cycling that came out of nowhere, inflation surprises. If the Forex numbers that we're anticipating are not intended, not suggested, not anticipated to be a big change, and then they come out as not a big change, then, sometimes they won't have a really big impact to our trade opportunities that day because they won't really rock the boat. But surprises in those can potentially really rock the boat. So knowing when they're coming, that's why this is especially important, because if they're flat on the news that they bring and the output that they have, then it doesn't end up having to be a big deal. But you want to be prepared because sometimes it is more of a big deal. And so if you just pay attention to that, Matt is excellent about talking about the dollar strength and correlation with the equity and commodity futures. And so that is a big factor that you can learn to understand the correlation of and watch that as well as part of your system. Also OPEX, option expiration cycles, if you haven't drilled into what that term means. Option expiration cycles is a factor because when options are all closing as a group, it can cause different sort of volatility and kind of wonking around as all of those settle out, basically. And so having these, macro information, it doesn't need to dictate your entry. You can still have your strategy and trade your strategy to the best of your abilities. But you do want to recognize that there's a different risk on the table when those days are hitting, basically. Now let's talk timeframes, because there is a common mistake in futures trader where you analyzing on one time frame and you trade it on another without really seeing how they connect and what the relationship is, and if they're together or if they're separate, and how to factor that into your specific trade setups. And so higher time frames generally always will set your bias. So if we are pushing up and we're experiencing larger time frame, higher time frame bullish moves, then in general, most strategies will say, I should prioritize the longs because the larger time frames are bullish. And then the lower time frame provides your precise entry. So in that situation, if you see candle patterns marching up on the larger time frame, hourly, 4 hour, daily, then you go into your smaller time frames and you're ideally generally looking for a long, and you want to get into a smaller time frame that can give you your precise entry based on your criteria. But if you just think like randomly, like 4 hour is bullish, I just want to get long, and you randomly hit a long, that could work out, but you also could get killed because within that larger time frame, there could be a lot of fluctuation. So that's why you got to really think about zooming in a little bit. So your weekly daily chart, right, establishes your trend direction, major support and resistances, whether conditions favor trend following or mean reversion strategies. So let that kind of be your compass on the greater direction of the market, right? 4 hour, 1 hour, that starts to drill down a little bit more specifically. And so that's where you can fine tune your levels. So last week I was on with Mike in the morning and I talked to him a little bit about how he lays out his charts. And it was awesome. He really talked about framing up his chart and the way that he looks at the 4 hour and the hourly chart to create his levels where he expects and anticipates the market movement at. And that is so key. Yeah, it's such a big deal because then you know where you're at on the map, basically, and what levels could have a serious reaction at them. Consolidation zones where catalysts had a lot of volatility and it really pushed off of it. And so that can bring your weekly daily chart down to a smaller time frame to start getting even deeper into your setup. For day traders, a lot of us in the prop funding accounts, you're going to execute on your 15, 5, or 1 minute chart somewhere in there, right? Everyone has kind of a sweet spot with their time frames. I like the 5, and then if it's higher volatility, then I'll drill in and I'll manage it on the 2 or the 3 even. So this is where futures traders tend to live after they've done the top-down analysis of figuring out their general overall view of the market from the larger time frames. So here's where you get your entry triggers, your stop loss, your momentum confirmation, but higher context frame helps you see this sooner. It helps you know, if higher time frames are bullish and we're in a pullback, then what I might be looking for is where this pullback could stop based on the support on the hourly and maybe 15-minute charts at that point. And so if in general I'm bullish bias based on my larger time frames, right, you drill into the 15 and you start to see where a pullback might hold for the next push up kind of deal. Okay, so those are kind of the higher kind of reviews almost, because I think a lot of this probably is not super surprising yet, but we're doing some reminders here too. Now, futures markets don't move at a steady, predictable pace, right? Sometimes they just do their own kind of whatever crazy town thing. So volatility and opportunity and risk does tend to cluster around specific recurring windows every single trading day. Now, we've seen this where people talk about, are you an opening bell trader? Are you an end of day trader? Do you like the more steady movements in the afternoon or like the Asian session? And so there's a different energy to the different times of the day. And I think that if you haven't really thought about it, you should. It's something to really think about. What is my style? When do I get my best setups? How do I manage it differently on the different time frames? And so knowing these windows really needs to be foundational to your setups, because a great opportunity in the morning won't be as consistent as it would be later in the day. So pre-market, there is a couple hours before New York session opens, which is at 9:30 Eastern. That is when there is some good moves. There's some news digestion, right? We've seen a lot of Forex Factory news comes out an hour before the New York session at 8:30 Eastern Standard Time. And so there's some news digestion from those information drops. There's some positioning coming into the futures market for New York session. So you a lot of times will see some levels consolidated on or defended, or a quick poke, a break of structure, and then a pullback in. And so this can cause some trapping of some wicks, but also it could start to frame up what you might anticipate in the day. So study that if you're a morning trader. And then market open, which is generally seen as the first hour of the New York session, which is 9:30 Eastern Time. That is oftentimes when you get the highest volatility of the day. but also you'll get some BS, right? You'll get some screwing around, some stop hunting, some volatility, some emotional moves where it'll take out everyone who's long, and then it will fall down and take out everyone who is short, and then it will start to set up a better move sometimes. And so false breakouts are really common in the morning. So if you're an opening bell trader, sometimes that's when trend starts and they fly all day. But not uncommonly at all is when it's going to wick out people on both ends. So if you trade that, I mean, sometimes your first trade really should be considered like a scalp and you lock in profits because it could fall back on you really fast. Like the 5-minute candles on a New York session, sometimes they're just dinking around, taking each other out for 45 minutes, right? So bear that in mind if you trade this time, that maybe you will get just a home run. It will just hold that support and fly. But golly, like it does a lot more dinking around than I would prefer. Jaja just said in the comment, the past few sessions, first trade has been paper trade, which I love that strategy because you can start to feel the energy of the market. You can put a trade on, but you don't have your accounts at risk because there is just a high risk of a lot of people get stopped out in the beginning of the trade and you don't fully know what the day is delivering. Are the longs going to hold? You can test the waters without risking your account. And then when you find out it holds, feel it out. Exactly. You get to feel it out, test it out, say, gosh, these I tried for the bullish and it was wiped out because there's definitely some bears sitting up there. Some, I'm going to wait and see what the bears got now. And so you can really either sit out and observe or trade it in paper or trade it in micros, and maybe your full size is a mini. Trade it sometimes smaller size or abstain and watch it. Sometimes what I will do is I'll watch the market from my phone in another room once my trade plan is set up. And then when I see what I really want to see and I see who's been taken out, who has won, who is on the winning side of the morning, then you can go and try and find your execution because there can be some false breakouts a lot in the first hour of New York session. Now, mid-morning is trickier too because sometimes it's excellent. Sometimes you really get nice trend continuation and you can really push a big move in the morning. Then after the morning wiggles kind of get out of the market, right? So you can get her wiggles out and then the trend can continue. So that can be a really good setup. This morning, it kind of messed around, took out longs and shorts, and then it had a really nice sinking trade that lasted an hour and a half today. And so that's an example of like, sometimes you get a really good continuation trade after the first hour of New York session sets up. It's a little bit more rational. Sometimes your risk is a little lower because it's not causing the big old wicks of the first hour of market open. So that can be a really good opportunity. Now we all talk about New York lunch, right? That's 12 to 2 Eastern. You can get lower volatility. The candles are a little smaller. It can get choppy. I would definitely encourage you guys, especially if you're still dialing in your system, to consider skipping that because you can get choppy. You can get like death by 1,000 paper cuts because the candles aren't necessarily huge, but you can get fake outs. You can get, I think it's pushing up, but really it was just like a small bullish candle in a chop zone. That to me is the most unappealing trading of the whole world, usually. Now, none of this is the holy grail. None of this ever that anyone says, honestly, is the holy grail. But especially there could be good continuation during this time too. But more often than not, it's choppy and it's like a time where you should maybe just not. Power hour is the last hour or two of New York session. Institutional repositioning, setting up into the close, a strong directional move into the close potentially. We saw that today that the bears tried to defend with some strength. And so that is definitely a time of opportunities as well. But I would encourage you to watch it and study it, like create a system around it. Do you involve VWAP in your strategy? Do you, make sure if you're coming in to consider an end of day power hour trade, make sure you have your levels up to date from the whole morning session. What held and what was the resistance. And so if you are interested in a power hour trade, come into that like prepared and have the information from the day drawn on your chart and ready to see what you can find. So a little different energy. I just wanted to cover that as well in case anyone hadn't thought about it, about what the opportunity looks like at the different times in the day, because you want to think about how those opportunities look and how you can best capitalize on them. Now, we all know about this, right? Scheduled versus unscheduled risks. Scheduled risks is something that we know. They appear on the economic calendar. You can trade intentionally around those as long as you know what to do about them. And a lot of times people will not trade the moment when these news hits and instead will look for a secondary pattern to present afterwards. And so this is anticipated, right? We all know about Forex Factory. If you don't, drop it in the chat and we will direct you. But it basically is where you can anticipate FOMC information, GDP, all of that will be anticipated and scheduled out when that news hits. And so if you choose to trade during that, especially if you're new to that, consider reducing your size. Or if you're in a really good trade coming up to it, protect yourself with stop adjustment potentially. But the bigger issue right now, which monkey in the room or whatever, elephant in the room, whatever the saying is, But the unscheduled events, so geopolitical shocks and surprise federal statements, random tweets, that is a very real part of our trading like it has never been before. And so when you're considering your timing and you're planning out your trades, like always have that in the back of your mind that it can happen at any moment. And you could be in an A+ setup at any given time and get your butt kicked by a random information drop. And so you want to practice having some instincts with that and some predefined rules of if you see this wild pump happening and you don't know what the cause is yet, don't just blindly chase it. Sometimes the wild pump is happening and it's like, I don't know, the world is over and we're sprouting rainbows out of every lake in the world. I don't know, some sort of super crazy, really good news. Sure, it could run for hundreds and hundreds of points. That's something maybe you could find an entry on and get on board with. But more often than not, it's a little bit of fakeness with it, right? We see a random tweet. It's not actually validated. There's a whole lot of BS behind it. And so in those situations, you could get a big pump and it could immediately be taken back. So see them, study them when they have presented, and then have predefined rules around them in terms of not chasing until you're sure what the underlying situation is. And does that create a situation that could have continuation, in which case you do want to figure out how to potentially get in on that volatility, because joining a momentum trade, there's a strategy with that, but you need to understand that it's a momentum trade. And so your risk is going to be different. You'll have to just have a stop that you just aggressively trail, because knowing it's a momentum and it can easily fly down and take you out, that's something that's really important to consider and weigh into if you're going to play with that or if you're just going to abstain and watch. And so preemptively planning your trade plan, always check your economic calendar right before you know, because some of that can be anticipated and there's no reason to not anticipate it. That's just be a part of your due diligence as a professional trader. And then also define in advance, what will you do if you see this high volatility moves? And when they hit, what are you going to do? Reduce size, sit out, engage. Now, after the news hits, post volatility can create some of those best setups. So that's the secondary move of if you get a big fly on aggression and then it does come back, what are you going to do about that? Are you going to join it? What does that look like? How do you get in? But have patience and a defined strategy with it. Okay, another poll of the audience, you guys. Has anyone ever been in a great trade and had news hit that you didn't know was coming? So what happened? Did you get killed? Did you fly and make a ton of profit? I feel like both have happened to me, where it's gone really well or it has really been terrible and horrible and it wicked and took my stop out. More often, I would say, for me, yeah, both. I feel like more often I've been in a winning trade and it has just killed me in terms of volatility, because it will fly and take out my stops and then fly in the other direction. Cried into my pillow, cried into my coffee, as that happens to me. That happens to me. So yeah, this is a very real part of this world. So just consider knowing that that is something we just have to factor in with our trades. And what are you going to do about it? Are you going to chase? Are you going to lick your wounds, shut it down for the day? It'll likely throw you into max loss if it hit your stop. And you guys too probably have experienced this. When it's a high volatility throw, your stop is not going to be honored. There's a liquidity event where it just blows through it and it fills you where it fills you. And so maybe your max daily loss is say $500. But if it's a volatility throw, you could lose $700 in a second, because it just filled you when it filled you and the market was moving so fast. And so that real cute, $500 max daily loss that was taken out by volatility could be even more than that. So watch out. Yeah, same. Me too, Jessica. Okay, so the two deadly timing sins: too early and too late. So when this is where I think the value in today is this exact situation, because this is where I do better when I do better with this, right? Obviously. But when your trade idea is directionally correct, timing your entry is where most traders bleed out, where most of us get our butts kicked. Because if you have the right direction, you're going to feel some kind of way about wanting to nail that trade. But there's two different ways that this can get us into trouble on the same setup. So let's do them separately. So the sin of being too early. And no judgment, I'm calling them sins, just, but I've been there. So, you're on my team. Anticipating the move before the confirmation arrives. You enter because it feels right, because you're anticipating, because market context supports the longs, not necessarily because you've got the confirmation per your system yet. And so the result is you get in on the earlier side and you might get stuck holding the bag. You're going to have to absorb the noise. You might get stopped out and then you watch it go without you. This can erode your confidence and your capital and can throw you into a potential tilt situation, because you can get super frustrated. I should be profitable. This is very frustrating for me because I did what I needed to do and I'm in the right direction of the market. And so this is also a big tilt trigger for a lot of people. And so the big thing there is you didn't wait for your confirmations. And we delineate our confirmations as a part of your trade setup, because you say, if I see XYZ, then the trade might be closer to ready and this is my best opportunity to get in. Now, the sin of being too late, that's the flip side of that, right? So that is chasing a move that is already extended. And that's kind of a FOMO driven situation where the risk reward is not ideal anymore. Your stop has to be very wide to chase that move. Your target is getting closer and closer every second. And you're entering as the smart money who got in ahead of time is exiting. So that's how you get to be a bag holder, is this entering too late. Chasing is the fastest way to buy highs and sell lows. It's basically the move has started and you're so irritated that you didn't get a piece of it that you're just going to get in even though it's late because it's still pushing and you should be in this trade, and you get in and you're literally the last one on the train and it reverses on you. And so that one is dangerous in terms of how on earth do you manage your risk on that, because if the move is already progressed, then you're just going to have like a momentum kind of following stop. And that is super dangerous for it just popping down on you so fast. Like for me, if I try for a momentum trade and it doesn't work, that's the fastest I'm ever stopped out because it comes right back on you so fast. Both of those are really tricky and they're really common. I have to say that these are experienced by all traders. Tell me if I'm wrong, but I'm not wrong. All traders have experienced both of these situations where you're too early and it dinks around and it just kisses you out by one more, like it's accumulating. And so it's letting everyone on the train or what have you. And so by being on the earlier one, it wasn't done accumulating and dancing. So you could take a little hit. And it goes. So, of course, on this slide, I have to give a nod to Warren Buffett, one of the OGs in our space. The stock market is a device for transferring money from the impatient to the patient. So what this looks like is really having a set of specific entry criteria. And you do want to make sure that you're waiting for that criteria to set up so you're not the one that's in too early and getting wicked out before it's really ready. A confirmation in that situation would have it you showing the trade is finally ready because we see all these things lined up and it has taken a half an hour maybe to get fully set up, but now the trade is just going to go. Those are the best because you get profits soon, right? And then impatient, goodness, chasing is that, right? So how do we not do those things, right? Let's talk tomorrow. How do we not do that as much? Because I want to also not do that as much. So let's talk it out together. Let's remind ourselves of what we're going to do to avoid these things. The best of our ability, right? Nothing is perfect. The market has volatility. That's probably a little bit why we love it. But in opportunity, there's also risk. So our cue with the bonus points on that, there's a lockout button. It helps a lot. But let's say you haven't traded yet. Let's say you're still making your plan and you're creating your bias based on your larger time frames. You know you want to try and get along because of XYZ. I see this direction. I see these supports holding. How do I join the longs? So you're setting up your trade plan and you haven't messed it up yet. So let's set ourselves up for success, right? So a confirmation is your objective trigger. It's a signal that the market is actually doing what you anticipated. It's not just what you hoped or what you thought was going to happen, but a confirmation framework that you can figure out on your instrument that you trade for your style and your time frame that you trade. That will help keep you disciplined without keeping you paralyzed, which Wadji and I have talked about this a lot, about having really set up entry next criteria, because then we can have more confidence and less fear around it. You just say, like, I saw XYZ, and so this is why I got in, and this is how I manage it, because this is what I do when I see this trade set up. It's so much less stressful because you have studied it and delineated it, and you are not paralyzed or as afraid, and you have the patience to wait because you want to see that closure first and you want to see it's at this key level and this held. So it's purposeful. It's a purposeful approach to your trading because you want to enter when your evidence has tipped in your favor, but not too soon and not too late. There's a sweet spot with all of this. And that really is a powerful point that I want to cover, because there's a psychology to that too, of waiting for the sweet spot. So a well-built confirmation process really can reduce emotional decisions, and it can keep your entries rooted in price evidence rather than anticipation. Because you could be really good at market intuition and feeling out where the market's going and understanding context and what the winning direction would be. But if you're trading with anticipation instead of evidence, that's a lot more difficult. The discipline of waiting for all of your stages without hesitation once they arrive is the core of a timing proficient futures trader. So timing proficient futures trader, right? That is an interesting mouthful that I don't know if you've thought of before, but it's basically saying when I trade my futures, I really want to be specific with my trading because I don't have a giant account. I'm not managing millions of dollars and I don't have a big buffer and I'm not trying to get a bazillion contracts filled. And so I'm not as price sensitive. No, I am price sensitive as a retail futures trader. I need to get a good fill because my account only can hold so much risk and I want to let it build. And I don't have a fat personal account yet and have the room and confidence to give it more room, if that's even the right answer for people. No, I think being really careful about price is where a lot of us in your early couple of years of trading is where there's power in getting the profit soon. Yeah, Waji says the more refined your rules are, the clearer your setup, the easier the management of your trade becomes. Exactly. Like clarify all of it and aim to really execute to the best of your ability, because it's just so much easier on your psychology and you get in profits faster, which is honestly my favorite part. We are traders for the profits, not gonna lie. And so if you can wait and get your best entry because the trade is really finally ready and about to cook, then you can really get your profits faster. You have to sit through less consolidation and less letting it finish to set up. It's really a good vibe. So you guys, what do you like to see for your go-to confirmation signal before entering a trade? Is it a close above a level that you've been waiting to see if it's holding? Is it volume at a key level when you're getting maybe a doji candle there? Does anyone want to drop what their like confirmation is that there is their favorite? What do you guys think? What is a good confirmation to say my trade is finally ready? I have seen this on my charts. It's go time. If Steve's bot says long bias, I love that. I don't think Steve's here today. We'll have to tell him tomorrow. I mean, Steve's bot can be a confirmation. Put that as part of it. Maybe a more robust system where you have multiple factors though. I love that for us though. Okay, y'all are funny. It depends, but break smells high or low. Yeah. I like a break out of a range and then a close above, and then I want to see a pullback. And I like volume too on breakouts. Volume at my key levels shows that potentially there's a lot of contracts being exchanged, which could be a good setup for an entry area. Yeah, Renkos are really good. When a Renko turns direction, like that can really show a strong point. Yeah, Ace, VWAP, rejection or bounces. I love VWAP, especially for power hour. That is definitely part of my system there too. Okay, different rules for aggressive versus conservative entry. So see, Waji, I mean, I know this because I know her, but she putting a lot of effort into your trade setup means that you really have looked and you've considered what a momentum and what a consolidation day, what those look like, and then what you like to see. And so that's what I would encourage you guys all to do is attend Maths Technical Labs on Thursdays, because they're a powerhouse for these concepts. But dig into your chart, ask questions, study it, back test it and forward test it, which means just to actively trade it. Basically, it's a fancy word of saying actively trade it. But trade your style and fine tune it and figure out what your best setups are, because knowing your criteria and being able to say, if I see these 4 things at my key level, I'm good to go. I love this trade. I want to get in for full size, or at least start and then add my full size when I get these other confirmations. It makes the whole project a lot smoother, basically. So timing isn't just about entry, it's also about sizing. Okay, so I just mentioned, like scaling into your trade. So volatility changes everything. During high volatility windows, such as during news events or the opening or closing of the day, a future contract can move 2 or 3 times its average range in the same time frame. So a 5-minute candle in the first 30 minutes of market open is not the same as a 5-minute candle at 1:30 in the afternoon New York time. They're going to be smaller and they're going to have less volatility and less clear signals to them. So trading your full size when volatility is high is a choice, because you want to make sure you have really high confidence in your trade to take those full size opportunities, because you're taking on full size risk. Your risk is more when the candles are larger. That's pretty much always a setup, depending on how you manage your risk. So make sure that whatever you're getting into, if you're trading during high volatility time, make sure the risk is something your accounts can hold. Because if you're trying to take a trade with the big high volatility energy, maybe consider trading half size, because you have to take a larger distance for your stop for the trade to be right, if it holds, etc. If you think about it this way, your position size should be inversely proportional to the volatility at the moment of entry. Bigger volatility, larger candles, smaller risk, or smaller size, because your risk has to be larger based on the candle size. So when you're still getting really good and you're dialing in your system, I know the urge is to trade full size always, but I would caution you to, if you're having to take the risk of that candle, make sure your size is appropriate so that your account can hold the risk, basically. It isn't really about, I'm not trying to encourage you guys to be timid or too cautious with that, but it's more about just making sure you're having a strong, robust risk management system. Yeah. I mean, more candles with more contracts with a smaller candle. Yeah. I mean, if your risk is tighter, if you get a killer entry at a doji and the risk is small, then you can, that amount that you would take to hold the trade needs to fit within your risk tolerance of your account, basically. So you get to decide your size based on the risk you have to take in order to hold the trade setup that you're in. Sometimes that means that you need less contracts or less size if it's a big risk to hold the trade. So I would encourage you to consider that as more of a professional approach, because your biggest thing is to not lose your accounts, to not have to reset all the time, to not have to deal with the emotions of losses when maybe you didn't have to do it. Maybe you squeezed a trade because there was too much of a risk and the trade didn't work out, but had you not squeezed it, it might have worked out, So I think it's good to not have like taking outside risks because you want to be able to survive in this game, which is how you get to the long-term profitability of the big names in trading that we know that have done it for decades long. They don't take too much risk, so they can't survive. So you want to catch the right moves with appropriate size. Again, Warren Buffett, because he's so on point with this subject today, but risk comes from not knowing what you're doing. So if you don't, you're kind of haphazard, you don't have a clearly defined skill, you're just sort of like kind of be like, I think that we're long, so I think I just need to buy. That's a lot of risk that you're taking on because you don't fully understand what your setup was and where your risk needs to be. And so it's not that knowing everything is going to make you have no risk, but more so the more defined your system is and the more specific your entry and exit criteria are, the lower risk you'll have because you'll understand the setup even better. A volatility aware size framework that just basically covers again what we just talked about there. Okay, so this is part of it too, of talking about session timing. So how much time is left for your trade to happen? The time remaining in a session is an underused variable in a lot of people's trade plans. A breakout trade entered at 9:45 in the morning Eastern Standard Time has hours of potential runway. That could be a home stinking run, right? Because it's very beginning of New York session. We could have an engulfing candle, which means that can fly for hours. That has incredible potential to get in on the early session of a high volatility session, such as New York. Different, right? The exact same setup entered at 3:20 in Eastern Standard Time has 40 minutes of runway. So if it doesn't move right away, or if it's not immediately successful, you're going to be, potentially taking a loss because maybe it was a good setup, but it just didn't have enough time, enough runway in the day to have that trade, right? So just think about that when you are considering your trades. It's run day. Oh, God, right? Get that stick entry in the morning and ride it all day. I'm with you. So early session trades, consider that your trade has a lot of time to develop. So you want to give it a little time to room and consider, especially in the early part of your day, holding a runner for the bigger, longer strategies, because that can really have the potential to be a home run day. That momentum can confirm it. You can hold, you can manage your stop on the smaller time frames, such as Matt's strategy of the 5-minute candle on the 9 EMA. You can, trail your stop at a reasonable distance so you're not taken out, but those are stick opportunities if you get in early. Midday trades, sometimes if there's lower volatility and it's chopping around, you want to think about appropriate scalping, like where it could respond to in managing your risk, because during that choppy time, going, a couple hundred in profit to a couple hundred red, like maybe that's not worth your time. But if it is, maybe you want to just have a strategy where you always lock in a couple hundred in profit and scalp it. If that is the time availability that you have to trade, recognize that you're trading during a potentially choppy season. And if we haven't proven to be a trending day by that point, to not expect a home run necessarily, because the context of the day has shown that potentially you're in chop zone. Late session trades, now this is kind of like a critical constraint too, because there's not that much time, right? So tight targets, you want to consider where a most likely response is, such as like a long up to VWAP. It might be really a place to scale out, and then consider a runner from there, because so many times at the end of the day, it is targeted and profits are taken at VWAP. That's a strategy. But then also give it room to run, but consider how much time it actually has and where you're headed to and what the levels are that it might respond to, and lock in your profits, because you don't necessarily have the ability to manage it on the next 4-hour time frame, especially being a prop trader. Your trades have to be closed by New York session close. That way everything can be squared up overnight. That's just the way it works when you're trading other people's money. Same across the board. So that is definitely a factor in the late session trades to pay attention to. How much runway basically does your trade have? Overnight is different. There's a different liquidity profile. Different money will trade in the after hours. So there's generally a little bit thinner liquidity. The fills are going to be adjusted. There's more news sensitivity, knowing that there's not like the market makers making the moves as they will at the start of New York session necessarily. But if a news tweet or whatever is announced in the after hours, it can be wild, right? We have certainly seen that as recently as a couple weeks ago. So they're very news sensitive in the after hours, because that is like the main catalyst that causes the big moves in the after hours. So you want to, if you're engaging in that session, make sure that that's a factor for you, that you always have a stop in place, because, or at least you're super managing your trade, because that is a risk during that time. And then positions held overnight carry a gap risk. We almost always see gaps overnight in one direction or another to some degree or another. It's very rare that we just open flat on the day. There'll be a move up or a move down, and that can be good information coming into your next session to consider. So just the different things to think about, that if you're still creating your trade plan, I want you guys to think about what a setup would look like in the beginning of New York session versus the end, etc. So the mind is the market. What was she even talking about? Okay, so this is where I get a little psychological. I've been a little bit more technical leading up to this, but I think this isn't really covered in a lot of other conversations about this, and that most timing failures are not analytical failures, they are psychological failures. Okay, you guys listening? Because this is what I do when I goof this up in terms of being too early or too late. It's not necessarily a strategy problem anymore. 5 years into my career, it's more so a psychological one. It's more so I was impulsive or a little bit edgy. The setup was there, and the confirmations came, right? The setup presented, the confirmations came, the trade played out. The question remains, did I wait for it? And that's the main reason why I brought this today to my psychology class, is because this is the clutch factor for most traders. Once you have a system, once you have a playbook, once you've done the work and you understand the time frames, you come down to what you're going to click. Okay, like when are you going to click your buttons? That is how we decide on how we execute and successfully manage this, or we don't. So this is where fear, impatient, ego, greed, FOMO, those get in the way of taking the right action at the right moment, right? Does that make sense? You guys with me? So fear-driven hesitation. This one's tricky. So it's a signal fire, right? The confirmation is clear. I saw it. It broke below my level. It did a retest. It's going. It's sinking. This is the trade, but you don't click the button. You freeze. What if it's not? What if I'm not sure? What if the next level holds? And the trade starts flying. So frustrating. But then you have the fear of being wrong. You fear of having another loss. Maybe yesterday was a red day and you really don't want to lose this day. So maybe you need to wait till you're super duper sure. But your confirmation came and you didn't get in and it starts to move without you. You also could have analysis paralysis in the situation, also out of fear. And so you miss your entry entirely. And then you're in the situation of like, shoot, do I chase? Because you had the setup and you didn't get in. So that's a fear-driven hesitation can get you in the situation of having to consider whether you're going to get into it afterwards. And then your risk is so high. So that is the psychological issue of fear, where your confirmation is there and you freeze for what reason or whatever reason, what have you. That's complication from psychology of carrying over a loss, regret, or just really maybe you're really close to passing your account, right? Maybe you're $300 from passing your account. So you really want this trade to just be perfect. So you hesitate and then you end up chasing and then you're in the back and then you chase to the end and then it takes a stop out and then you're mad because you had the trade and you didn't have the trade and now you're only $200 red, but you could have passed the account had you not hesitated. Do you see how this tilt spiral is so easy? So that is something to consider when you are really trying to be your best with your trade management. Now, impatient and fear of missing out, if you enter before your setup matures because you're watching from the sidelines, feels unbearable. So impatience is one of the most expensive emotions in trading, right? This is where you see, I think the bears are going to own this. I think we're going to sink today. Well, this morning, I don't know who traded it, but NQ and ES had a bearish day. However, they pushed higher and they took out a lot of stops. A lot of people who chased the first morning push down got their butts kicked from getting in too early on this. When they did that big retest and they went up and they pushed higher, like 10 minutes into market open today, took out everyone who shorted in the first move that didn't wait for a retracement. Now it did retrace higher, but then it fell. And so this is a tricky one. But if you see a potential setup, but you don't have clearly delineated system for entry and you jump the gun, basically, it can do another retracement. It can do taking out the liquidity before it finally takes off. And so getting in before you see all of your criteria is super dangerous, because then you get in the situation of like, my trade plan was right and I got my butt kicked because I was stopped out and locked my accounts before it actually happened. And now you can't anticipate everything perfectly. There's going to be caveats to all this where you just can't dial it in. Yeah, dude, I literally, I get to have these classes and say them so fluidly because I have been in these situations. Get out cheap, get in cheaper. Yeah, I mean, manage your risk. And if you're not sure how it's playing out, like shut it down. And then you get even the better entry. You get more confirmations, you can get back in. But if you are not honoring your risk, or you're taking on too much risk or too much size, you can basically shoot your foot off before the trade actually happens. So if you have a reasonable risk and you wait, you can get really good entries, and you can trade more than once in a day, right? When you get your setup and you still have room to trade because you haven't oversized or over leveraged or really monkeyed around and got really impatient entry. And then last one on here for the psychological impacts is the ego and revenge trading. So after a loss, you force the next entry to make it back, right? It's like called fix-it energy. Timing is abandoned. You're trading your emotions. not the market. You're saying, well, my short didn't win, so I guess these damn bulls that stopped me out must be the energy. So then you long it, but your short would have worked because your analysis was for the shorts and that analysis was still accurate. But you're pissed off because the bulls just took you out on their retracement. So then you try and just be a bull because the bulls just took you out. But they just pushed to one level higher and then rejected, and the bears were still the trade. Who's done that? Because I have. These situations are an example of your psychology hurting you. And if you can lock into really being very specific and technical on your timing, thank you, Ace. I'm guilty as well. This is the cinch page of all of this presentation today. This is where we need to put in the work most of the time. If you don't have a technical system where you don't have clearly defined entry and exit criteria that is logical and price action based, do that as well. But the psychology part of this whole conversation is this. I know, dude, Pikachu, like I'm same. I have done it. I've done it more than I wish I would have, but you know, it's like how many times you're going to touch the fire before you really stop touching the fire. The more awareness we have, which is why I'm so happy you guys all came to the psychology lab today, because this is putting awareness on it. Like coming and hanging out with me on Tuesdays is basically saying I am still having these little issues with my psychology and I don't want to have little issues with psychology. And so I want to have these in the forefront of my mind of counteracting these and having a set system that I trust and respect and honor so that I don't give into these, and knowing that this is a real risk of being really good at trade setup and trade management and not giving into these experiences. So to kind of bring it all together, I think we have to manage both caution and courage. That way we can execute to our best system. So elite timing requires holding two seemingly opposite qualities at the same time. So alone caution can be paralysis. It can lead to hesitation and fear and not taking your trades. And alone courage can be reckless. But together they become like a really disciplined decisiveness. So I think this is a hallmark of a really skilled futures trader, is having messed this up on the previous slide, having doing all that bullshit and getting yourself into trouble and deciding, how do I need to approach it differently? This is it. You have to have caution and courage and an established system. So what caution looks like is you're waiting for all of your confirmation criteria to be met before entering. You're reducing your size near high impact news or volatility. That way your risk is not outsized for your account. You're recognizing when a setup is not there yet, so you don't see your criteria, so you're not getting in because you haven't had your criteria met. And it's sitting on the sidelines without guilt when it's choppy. Just because you have time to trade, if your conditions are not favoring your edge, you don't execute, right? And then honoring your predefined stops every time. If you say, if this level holds and I get in here and I go to here, my stop is below this candle, that should be honored every time. And so that is you being cautious and being attentive. This is strong positive caution where you have these rules. So maybe screenshot this if y'all are near your computer, because having these rules in place will protect you. This caution is not hesitating or weak. This is smart, attentive to your trade plan approach. Now, courage on the flip side of that, on the more like, let's get it, right? Pulling the trigger when your criteria are met without hesitation. So say you have all this criteria for your trade setup. When it sets up and it gives you that sign, you got to go for it, because this is the strategy that you have studied and is part of your plan, and that how you understand the market, and your statistics show that this is wins more than it loses. It's not a guarantee, but if your criteria sets up, you're at your computer and you see your entry criteria, like you gotta click, right? Like that's what we're in. This is a business of trading. So you gotta, like, even if you're nervous or uncomfortable, or you had a loss yesterday, you really want today to be a win, you can't win if you don't execute, right? So we have to have some courage behind who we are bringing to the charts. You have to be able to, like Ace alluded to earlier too, like if you get out, you can get back in. You can re-entering after a stop out. If you got in a little bit too soon and you had a small risk and your accounts are still okay, when the setup resets cleanly and you get another confirmation that fits with your strategy, you can go again. I mean, I'm not trying to tell you to go again if you can't go again, but if your account size has that wiggle room in it for that day, like take your setups, but then also size appropriately, right? Size appropriately and high conviction, well-timed setups too, though, right? So this means that if you have an A+ setup, like shoot your shot, go for it. Put your size on the line. Maybe get in when you get your confirmation, when you get a secondary confirmation or it's proving itself. You can even add a little bit more if you can get in soon enough, right? You can size decent on your A+ setup if you really studied it and you know what that looks like and how it's presented and your confirmations are there. And you can trust your process through to a drawdown period, which I love. And I want to just tell everyone, like if you're in a drawdown, study your system, but you can trust your process in a drawdown, Acting on the signal and not on hope is a powerful approach to trading. That is how we get to trading success. So I think that having a mesh of both of these and honoring both of them is the secret sauce to navigating this whole situation, to honoring your timing of your setup, of your trading strategy. Pretty much, Ace, that's pretty much what I said. But don't hold me to it. You're the one who's executing. But, if you have studied the market and you have a killer setup, and you take a half size, you might feel some kind of way by not fully going for it. You know what I mean? So just, have that in the back of your mind and work up to it. If courage is something you're getting more strength behind, you can work up to that. I don't know. Justin is killer. I'm with you on that. Okay. Quick poll before we shut it down. What is your early struggle? Is it being too cautious or being too bold? I'm not judging because I'm going to put mine in the chat, but be honest with yourself and share it in the chat if you're up for it. I think each one of us, different personalities, will have a different tendency. I definitely I'm on more one side of this than the other, and that has been my struggle point. Do you guys want to guess? Tell me yours and tell me mine. More cautious. That's probably why you have your fat wins, because you really wait for the best thing. Yeah, cat. I'm going to type mine. You guys can't see my face. I'm way too bold. I'm like, I think it's going to go this way. I'm just going to go. Yeah, that's dangerous for me. I definitely have had to counteract being bold and pretending that was courageous and strong and brave or whatever. But sometimes bold is just getting in too soon and not being patient enough to wait for my confirmations. And that was a reality I had to face in recent years of had I waited for my confirmations, I wouldn't have been stopped out and I could have slayed that trade. Bold pays more because, this is why I do it, right? It's because sometimes I get sick entries. The bold is tricky for me, especially. I have been able to capitalize on some really excellent entries. And so it's tricky because that is a habit that I have given into for times. And so I will sometimes get in before all of my confirmations are set up because I really have a strong intuition and I can see the trade kind of coming in advance. But if I'm not waiting for all my confirmations, I have absolutely been stopped out a lot of times. So caution, I think, pays over time because your accounts survive. And so I really do believe that it's a dual mandate, right? Dual mandate. Both will hold you through. We'll get along. Oh, everyone here. It's great. Okay. This is just a review on all of it. I'm going to bring it all in here at the end here. So a world-class pilot does not rely on memory only before takeoff, right? They just don't. They use a checklist and they use a system that is predefined and you have to honor it. The same principle should apply to futures trading. A pre-trade checklist that factors in timing. You remove emotion from the equation and you ensure that every entry meets your standards before you touch the order button. And then when you do, it's because it met all your criteria and you're going to honor your system. So you always make sure you double check your macros and your fundamentals that could have the impact during your trading session, right? That's a given. We know how to do that. Time frame and not alignment check. You start from the top down. You go from bigger time frames. You drill it down into what kind of a trade am I looking for today? Am I prioritizing shorts or longs? And then what does that look like? You want to try and trade with structure in general. That is most often the most successful. Session and time remaining check. What time of day are you trading? Can you get a home run because it's early in the session, you have a ton of room to run, or is it almost done and the context is more favoring tighter targets, something to factor in. But the biggest thing for all of us once you have a technical strategy is your psychology, right? Make sure that you are calm and you honor all of it and it meets your criteria and you prepare. Paul Tudor Jones, preparation is everything. The rest is execution. So prepare the best you can and then take your trades, right? Take your trades. I think you gotta, bring it all together as a part of how we do. And the inner game, I think, is a bigger factor than a lot of people give credit to with timing the markets. That is why I brought it to my psychology lab today. And I did spend some time reviewing the technicals behind it and the things to factor in your trading session. But I really want to encourage you guys to think about your inner game with your timing and recognize if you're someone who shoots their shots too soon and it is a problem, or if you hesitate and then you end up in a chasing situation, taking outsized risk, or just irritated about not getting the trade. Honor the mind over the markets. So consider just when you're making your trade plan the next couple of days, at least hear me in the back of your mind about what it would look like to get my confirmations and then trading to the best of my ability when I see my confirmations and honoring that trade system. It's really a powerful choice because then you're going to start to lock into your habits day over day, and then habits become your strength, your superpower. They become who you are as a trader. They become your identity as a trader, the habits that you honor every day. And so having these psychological boundaries where you always honor a system is going to make you a more effective trader on the technical side. So that's what I got. Thank you for joining me for Mind Over Market Psychology Lab on Tuesdays at BluSky. It's been wonderful hanging out with you. If anyone has a topic that they would like me to bring up and cover and dig into, I am super available for that. Thank you everyone for coming today. If you have a topic that you need, DM it to me, put it in the chat anywhere, tag me in it, and I will tackle it 100%. You make a request, I will get it done. Thank you guys for being here with me though too. And Matt's Technical Labs are Thursdays at market close, so you're not going to want to miss that as well, because the strong trading strategy is the underlying thing of all of this. Like, we get to delve into shoring up our psychology once you have a really strong technical edge. And so I think that they both need to go in tandem. You guys have a wonderful rest of your day. Thank you for being here with me today. Take care, guys. Bye.